Well, banks or credit unions, what makes the most sense? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thanks so much for joining me today. You know I do appreciate it. Well, are banks or credit unions the best way to go for a car loan? Well, we will cover the ins and outs and the pros and cons so that you can ask better questions. It's all about asking the right questions, and we try to get that done at Prudent Money. If you have a question for me, please go to the website at prudentmoney.com. And once you get to the website, you can always send me a question by going to the top of the front web page, and there's a link to the Ask Bob site. And you can just go send in a question. I'll get you taken care of. Very easy. All at prudentmoney.com. Today, we're going to be talking a little bit of a continuation of what we were talking about yesterday about refinancing a car loan. I think that most people have heard about refinancing a home, but very few, and it's kind of surprising, think about refinancing a automobile. Because just like with a home, the automobile has a certain value to it. And you can always, if you qualify, you can borrow up against that value. The thing that the banks like or the credit unions like is that it's an asset, and it's available as to offset a lot of the risk. So one of the good things and why you're seeing a little bit more opportunities to refinance a car, and what's great about it, as we'll talk about, you'll see this, is that it really comes down to three main steps when it comes to getting out of debt. First, you got to have the payments got to be right. Which is driven by the interest rates. You got to have that to be the right thing, and then the time it takes to pay that automobile off. Now, keep in mind something. And I was talking to somebody the other day that had a lot of debt, and she had been paying on that debt for so many years, just kind of going through the drill. And I don't know about you, but life seems to just you go through the days, and 1 week turns into another week, 1 month turns into another month, and all of a sudden it's a new year. Time just absolutely flies, but you keep on paying that minimum payment. And if I could encourage you to do one thing, it is to increase that payment to cover more of the principal that you're paying it down. But what she found, she sat down and started looking at her books, couldn't believe that how much progress that she has been making. And that's the thing, is that I think people pretty much ignore their debt. They make the payments, of course, maybe come out automatic bank draft. But she told me, she was saying, if I would have known I was this close on some of these debts, I would have put more money into it. Because I think you get motivated when you look at it and say, I've done the bulk of making payments. I've done the bulk of waiting. And now I'd really like to speed this process up and get out once and for all. And if I could encourage you to do one thing, and this is across the board, is that the question that I always get is, what are some of this world of uncertainty and financial anxiety? What's the one thing that I could do to make sure that I am being a good steward with what God has given me? Number one, you do get out of debt. You put a focus on it. You're intentional about paying a debt, getting out of debt. And once you get to that point, you are in a solid place. The next thing you want to do is make sure that you build up and restore maybe your emergency fund, that you have plenty of money to go to and get if something happens. That's one of the biggest builder of debt is the unexpected issue that pops up. And we're often, it's going to happen. It just don't know what it's going to be, but it generally happens to people unless you just happen to be lucky enough to be one of those people that it never does happen. But emergencies come up, and where do they go? They go on the credit card because we don't plan for them. And this is why it's so very, very important. So the question came up, I understand about getting out of debt. I understand about refinancing a car and why that makes sense. But are banks or credit unions the best way to go for a car loan? Well, let's talk a little bit about refinancing a car, the bank is looking for people, and this is the good news and the bad news. Depends on where you sit on the FICO score scale. If you've got a good FICO score, got a strong one, a high one, then your opportunities, assuming you're gainfully employed and all those good things, your opportunity to refinance that car is a great opportunity. The problem that you're going to run into is that I think a lot of these places, a lot of these banks, a lot of these credit unions, they put these teaser rates in. They kind of make it sound like if you don't have as great a credit, you can still get a new car loan or a used car loan. And you get in there, and then you find out, well, that's not really the case. The people who benefit the most from this are the people who have, they're consumers that have excellent credit. So that's the thing that you have to keep in mind. So these are the right questions that you want to ask, because it does come down to when you are looking at a note that you've been paying on it, and you're trying to figure out exactly how much longer it's going to take you to get to a point where you're debt free. But you're typically focusing on the interest rate, and if you're doing it the right way, a lower car payment simply means that, or one of the things it can mean, is that you are paying a great cost, a great interest rate, and it's now this new lower interest rate is going to allow you to have a lower payment. Now, as long as you don't change anything, as long as you don't make adjustments to where you are keeping that payment lower by extending the debt out, a couple of years or whatever it might be, what you want to do when you get into these situations that you have the opportunity to refinance a car is you want to get that low interest rate, get it locked in. You want to get it, at least, what I would suggest is don't take the lower payment, continue to pay what you're paying, and you'll get out even faster. What you don't want to do is add to the debt. You want to come out having refinanced your automobile, come out on the other side with a better situation than when you went on. So lots of things to consider. And I think the question to be asking is, can I lower my interest rate without unnecessarily extending the amount of time I am on the debt? So very important that you get it right. And it's one of those things that banks, credit unions are there to lend money. And so in order to do that, they're going to show you all kinds of different ways you can consolidate debt, that you can lower the payment, and you just want to make sure that, once again, you are walking away from doing this in a better place than when you before you signed on the dotted line. Well, let's talk a little bit about whether you use a bank or a credit union, which is the best way to go. Let's go through some of the most important aspects of a loan. First, we want to start with interest rates. Which one is the lowest? A credit union typically has a lower interest rates than banks. Banks often higher. And you have to look at one big major difference between credit unions and banks to see why they can do that. I mean, they're all working off the same interest rates. And so the interest rates doesn't give them a competitive advantage. However, with the credit union, you do have a little bit of a competitive advantage because of the way credit unions are set up. They are set up usually as nonprofits, and it just doesn't cost them much to run their credit union as it does a bank, which has a lot of regulatory issues, and it's just more expensive at a bank most of the time than at your credit unions. Credit requirements. With a credit union, it may be a little bit more flexible. With a bank, often more standardized, whereas a credit union might be a little bit lenient. They want to find out a little bit more about why your credit is the way it is. They might give you a little bit more flexibility than a bank, which is just pretty cut and dry, kind of run it through the machine and see what it says. The fees with a credit union often lower, and with banks it just varies. That's one of the things that, especially hidden fees, you got to really check and make sure that you're okay with. Personal underwriting, which is a whole lot better than having everything so very standardized. It is more likely, personally underwritten through a credit union, less likely at the large banks. So you might get a little bit of that personalized service and process with your loan to seek a little bit more information than what a standardized loan document will let you to write about. But that can definitely help you and influence whether or not maybe that you even get the ability to refinance, or that you get just a much lower interest rate than you already have. Membership, credit union, of course, it's usually required. Banks, no membership requirements. You have to do your homework and find a credit union that you can join. Here's a couple of examples. I've known of credit unions that if you live within a certain mile radius of the credit union, that you can join. They try to make this very simple to join so that you can get their business. There's also this is no advertisement for this credit union, but PenFed, the Pentagon Federal Credit Union, they will allow you to join based on a family member that's been in a certain part of the military. But there's a lot of different ways that you can join, but membership is probably one of the key pieces of the process. Convenience and technology. This is hands down where banks have credit unions beat. And if that's important to you, then that's one of the things that you always need to look at, probably on the banking side. Keep in mind, though, those bells and whistles are nice, but do they get you out of debt quicker? And that's the key. Is, I think, more important than whether or not they do have that convenience and the technology that goes along with it. A credit union is best for rate shoppers, especially good to fair credit, and for a bank, existing customers and convenience. So that gives you a little bit of an idea of what makes the most sense when it comes to banks versus credit unions. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you got a question for me, go to the website, www.prudentmoney.com. For now, we are going to a break. See you on the other side. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's Destined for Victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9 right here on KDKR and KYJC in Commerce, your station for life.
This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Today we're talking about banks versus credit unions, and we're talking about the process of making the best decisions when it comes to not refinancing a home, but refinancing a car. And especially, one of the things we haven't mentioned is, besides the lower interest rates that you can find in this particular environment, and you can also find some great opportunities to do this, that cars have gone up in value, and which is something we haven't really discussed, but that's important to understand, because the more value in the car, the more equity built up in the car, the better this turns out to be. And if you do it the right way, when I say do it the right way, that means that you went through the process and you came out on the other end with a much better situation versus than you did at on the other side when you first started. That's what we're looking for. We're not looking for just to lower the payment so that you can take out the note for another couple of years. No, we want to lower the payment at least with the new interest rate, which drives the cost down and makes it make more sense. So let's talk a little bit about some of the questions that you should be asking today. Why can a credit union offer a auto loan rate lower than a bank? And we talked about this. The non-profit member-owned institutions makes a big deal, and it gives you the opportunity to take advantage of really just it's the banks, the credit unions. It's just less expensive to run them, and those savings there they can translate into product, which means they can show you low rates on things like automobiles. Number two, do I have to belong to the credit union before I apply? Absolutely. You need to find, and we talked about this, you need to find one that you can become a member of. And will joining a credit union hurt my credit? Absolutely not. Simply becoming a member generally isn't what hurts your credit. It's the important issue is the loan application. A lender may perform a hard credit inquiry when you apply for refinancing. A hard inquiry can have a small, usually temporary effect on your credit. What that's talking about is there's two types of credit checks. There's a hard check and there's a soft check. And what banks are notorious for is saying, you can get this credit card. All you have to do is do a credit check, and we'll do a soft credit check so it won't affect your credit in any way, because a hard credit check is like a 3, 4, 5 point deduction from your credit report, and you just want to minimize the use of those. So they do this soft check, and as they said, won't affect your credit. But then if you pass the soft check, then they will do a hard check in most cases to validate and confirm everything is true, and that will temporarily put a mark on your credit report, just so that you know. Should I get quotes from both my bank and a credit union? The answer is absolutely yes. I'd probably go further, check your existing bank, at least one credit union, and perhaps another reputable lender. You're shopping for money just like you would shop for a car itself. Compare the APR, the loan term, the monthly payment, fees, and total amounts you'll repay, not just merely the payment. Very important to know what goes into any loan, and there's always the opportunity for costs to be a factor. Does shopping, and this is something very important to know, does shopping several lenders hurt my credit score multiple times? Credit scoring models recognize that consumers do shop for auto loans. FICO says multiple inquiries for auto loans made during a rate shopping period are generally treated as a single inquiry, very important to know, for scoring purposes. It really comes down to the FICO model, what they're looking at, but its shopping window is generally 14 to 45 days. And but very important to make sure that you understand what might affect your credit score and what might not. Should I compare APR or just the advertised interest rate? This is a question that confuses a lot of people. Look closely at APR, but don't stop there. APR incorporates certain costs of borrowing and can make offers easier to compare. I would still ask the lender, what is my rate? What are my fees? How many months is the loan? And how much will I pay in total if I make every scheduled payment? That last question can expose a supposedly cheaper loan. So you want to make sure that you know exactly, once again, what you're paying for. Number 7, what fees should I talk about or ask about? Ask about application or origination fees, title or lien fees, state fees, and any other lender charges. Also check whether your existing loan has any prepayment penalty. You want to know you want to know the total cost of switching loans, not just the new interest rate. Good point. Number 8, what if the credit union lowers my payment by extending the loan another 2 or 3 years? This is what we talked about you don't want to do. You know, a $700 payment dropping to $525 sounds wonderful, but if you've got 3 years left and the lender puts you into a new 6-year rate loan, well, that just violates the principle that we talked about before going into this situation, that you don't make the kind of changes that make the loan a not so good way to in a refinance. So, you know, adding years to it is not what you want to do just for the sake of lowering that interest rate. And you know, a lower payment. Listen to this: a lower payment and a better loan are not necessarily the same thing. So just because you get a lower payment, and that's what you see a lot of that in the car business, where they pitch the lower payment to you, and you really have no idea what backs that up. Number 9, can I refinance through a credit union if my original loan is through the dealership or a major bank? Yes, generally that's exactly what refinancing is. The new lender pays all of the existing auto loan and replaces it with a new loan. However, the vehicle's age, mileage, value, amount owned, and the lender's particular underwriting requirements can affect eligibility. And number 10, how much does my credit score need to improve before I shop for refinancing? And, you know, it's interesting. There's no real magic number because lenders have different ways of pricing what they call their tiers. But if someone's score has significantly improved, say from the low to mid 600s to the 700s, I would certainly investigate refinancing. Even without a dramatic score improvement, changes in market rates or the borrower's financial circumstances can make shopping worthwhile. I think it always makes sense to call and ask and know your credit score ahead of time. Say, you know, just a typical FICO, my credit score is this, and just trying to figure out whether or not I can refinance and want to do so if I can. When is refinancing not a good idea? That may actually probably be the most important segment of today's segment. Refinancing may not make sense when the rate reduction is tiny, fees wipe out the savings. I think you really do, though, have to double check and make sure that it does make sense to refinance a car. I think we fall sometimes into the mistake of assuming that just because the lender is willing to loan the money, willing to do the refinance, that's a good deal for you, or because the interest rate was lowered. And that most of the time it will be a good idea, except you just want to double check and make sure that it is as good of a deal as you think that it is. You know, this is what you got to take advantage of. You know, getting out of debt, which I think is very important in this environment. We discussed this a little bit earlier, is making sure that you got the lowest of interest rates, making sure that you're paying enough in above the minimum payment to make a bigger dent into that overall debt, and let time work into your advantage. I have known so many people who have just gone through the process. We'll talk a little bit about this, going through the process of getting out of debt. They go through and they just continue those payments, and they get to a point where they go, wait a minute, so much time has passed. I can actually maybe get out of this debt. What they've missed is the opportunity along the way as their credit score has gotten better. They've missed the opportunity to maybe take advantage of some lower rates. And I think this is one of the downsides to most consumers in the way that they look at debt. It's kind of one of those things where as long as I ignore it, I don't acknowledge it, it's not this big of a deal. And I think we've become really good at just kind of living a life of denial and just assuming that we'll be in debt forever. You won't be. And I've talked to too many people and counseled with too many people to know it can be done, and you can get into a really good financial period. And here's what ends up happening is you continue to pay that debt off, and that a lot of the metrics of the credit score start to improve and it gets better. You start getting tons of opportunities to refinance debt. And so we turn back around and we go, okay, we look at debt A and look at debt B and determine, if I were to refinance this, would it be a big, give me an opportunity to get out of debt quicker? Remember, you want to go into, as you go into a refinance, on the other side of that refinance, you want to come out much, much better because you went through the process. So just a couple things to remember and consider as we try and figure out this crazy world that we live in when it comes to money and stewardship. Hey, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. If you've got a question for me, please go to the website, www.prudentmoney.com, and send it in, because I am all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.